Hello. Chinese stocks have had a torrid time of late. There have been a number of reasons for the stock price decline. However, some Chinese stocks possess strong fundamentals, but the stock price has been badly punished. JD is one such stock. Today, we will be discussing the JD stock delisting fears, the geopolitical tensions arising out of the Ukraine war, and we will take a look at JD's company fundamentals. Hope you find this video informative. Guys, a lot of work goes behind the scenes in making these videos, and your help can go a long way. May I ask that you hit the like and subscribe button so that you continue to benefit from our top quality research?
A quick look at the disclaimer section. JD, just like a vast majority of other Chinese stocks, seems to be struggling from the FUD fever. FUD, if you're not aware, stands for fear, uncertainty, and doubt. As you can see from the stock price performance, a lot of fear, uncertainty, and doubt has already been priced in. On one hand, we have the fundamental story, which is solid, as the business is doing well. We'll discuss that later. On the other hand, there are various macroeconomic factors at play that have suppressed the stock price. The question now is when, if at all, will this bubble of fear burst? Let's first discuss arguably the biggest elephant in the room, the delisting risk. The risk is not new and started to surface at the end of 2020. It all started when President Donald Trump signed legislation that could remove Chinese companies from US exchanges if American regulators were not allowed to review the financial audits. The Holding Foreign Companies Accountable Act required companies to establish that they are not owned or controlled by a foreign government and allow the US Public Accounting Oversight Board to review their financial audit. This started a downward spiral of Chinese stocks. The Chinese stocks kept plummeting when on March 29, 2022, the SEC said various companies such as Beijing, Yum China, and Zylab have been cited for not adhering to the Holding Foreign Companies Accountability Act. This act gives the SEC power to delist companies and ban a company's shares from being traded if the company fails to allow US regulators to review their company audits for 3 straight years. It's the first time the SEC has warned companies that their shares are at risk of being delisted for violating the act, which went into effect in late 2020. The SEC has given these 5 companies until March 29th. In the last few years, many major US listed Chinese companies like Alibaba, Baidu, and JD.com have completed secondary stock offerings in Hong Kong. In the event of a stock's delisting from New York, investors could exchange their US listed shares for the Hong Kong listed ones. The delisting fears should already have been priced in, as it's not new information. As I mentioned earlier, this already started at the end of 2020. Therefore, investors' behavior concerning the SEC announcement in March seems a little overstretched. Furthermore, it was just recently announced that China is weighing giving US full access to audits of most firms. The delisting fears should have subsided as China is thinking about giving US full access to audits of most Chinese firms. This is certainly good news for the investors as the uncertainty seems to have abated a little bit. The next thing that we'll be discussing is China's Russian connection. China has remained on the border when it comes to the US Russia geopolitical tensions in the light of the Ukrainian war. On the one hand, the Chinese president Xi Jinping has criticized sanctions imposed on Russia over its war against Ukraine as harmful to all sides. And China has also remained sympathetic to Ukraine's sufferings. However, it has also highlighted that it was ready to help broker peace between Russia and Ukraine. However, China has avoided criticizing Russia's invasion. China is also considering to invest in Russian energy companies, which has made US extremely concerned that Russia could find a way around its sanctions. All this geopolitical drama has added to the uncertainty surrounding Chinese stocks. Let's have a look at JD's fundamental story now. JD reported robust earnings, before the SEC issued its delisting warning. It reported revenue of 275.9 billion yuan in 2021 Q4, 23% year over year. Its full year 21 revenue reached around 952 billion RMBs. It has been growing at a CAGR of 30% from 2016 through 2021. Robust performance for JD, even as the macroeconomic environment in China slowed considerably over the past 2 years. Furthermore, the company also made strong gains in its annual active customer accounts, which reached 570 million. Notably, it increased by 19% year over year from 471.9 million in the previous year. JD's gains were also broad-based. JD reported that its revenue in JD Retail grew 21% year over year, and JD Logistics revenue grew 28% year over year. Furthermore, JD also highlighted that it expects its 3P business to continue growing faster than its 1P business. JD has also invested significantly in its new businesses. It is making significant investments in Jingxi, the e-commerce business hub targeting consumers in China's lower-tier cities. The cash flow generation has been robust. The adjusted operating cash flow for 2021 was at 44.8 billion yuan, and the free cash flow was at 26.2 billion. JD has been strategically making capital expenditures for development properties, which can add a lot of value to JD in the coming years. It's apparent that JD continues to have strong fundamentals and has been experiencing robust growth in operating leverage. JD's fundamentals do not seem to have worsened, but its stock price movement over the past year has been due to the macroeconomic environment. We discussed the stock delisting fears and the China-Russia relationship in light of the Ukraine war. The stock price has corrected significantly, and there are some signs of delisting fears abating. The question now becomes if you are willing to take a position and buy the stock, or would you rather wait it out?
If you found this video useful, then I urge you to join our research platform. It's completely free, there are no hidden costs, and that's the place where we publish top quality research covering companies with the capability to compound in the long term. And that's also the place where we publish research discussing key investment concepts. So if you would like to increase your knowledge of investing, then you would surely benefit from joining that platform. The link is in the description section below. Guys, if you found this video useful, then don't forget to hit the like and subscribe button.